Every week, we break down the global money moves that actually impact your life, from interest rates to international markets. If that sounds useful to you, consider subscribing. It helps us keep going and keeps you ahead of the curve. Mortgage rates are rising, and it's not just the Fed. It's something much deeper and much harder to fix: a global shift in bond volatility. A quiet change in who absorbs that risk, and a policy decision from Taiwan, not Washington, could make U.S. mortgages even more expensive. Let's break it down. Since the pandemic, housing has been the quiet foundation of the U.S. economy. Locked-in mortgage rates under 3% insulated millions of homeowners from rising interest rates. That's why consumer spending stayed strong, even as borrowing costs surged. But here's the problem. That shield only protects those who already own. For everyone else, first-time buyers, young families, recent movers, affordability is collapsing. They face nearly 7% rates, soaring home prices, and limited inventory. They're competing in a market shaped by yesterday's cheap debt, but paying today's high-cost price. And that divide is dangerous. It traps homeowners in place, freezes supply, and leaves new buyers priced out. This isn't just a housing story anymore. It's a structural breakdown, and it's getting worse. In 2023, 30-year mortgage rates jumped above 8%. They've since cooled slightly, but remain around 6.89% as of late May 2025. Existing home sales dropped again in April, down 5% from March and 2% from a year ago, to a seasonally adjusted annual rate of $4 million. Meanwhile, the median existing home sales price rose to $414,000 in April, up 1.8% from April 2024. But the affordability wall is closing in, and what comes next may be worse. The Fed sets short-term interest rates. But mortgage rates are tied to mortgage-backed securities, and they're behaving differently. Before the pandemic, MBS yields were just 60 to 80 basis points above treasuries. Now that spread is 150 to 200 basis points. That means borrowers are paying 2 to 3.5% more than treasury yields, not due to credit risk, but structural shifts. This isn't a temporary spike. It's a lasting change in how the mortgage market works. Fannie Mae and Freddie Mac are government-sponsored enterprises. They don't issue mortgages directly. Instead, they buy loans from banks, bundle them into securities, and guarantee payment to investors. That makes them the backbone of the U.S. mortgage market, helping lenders recycle capital and making long-term fixed-rate loans possible. But in 2008, both came close to collapse. The U.S. government stepped in and placed them under federal conservatorship, where they've remained for over 15 years. Now, there are discussions about taking them out of conservatorship and returning them to private ownership. Here's the risk. Even though investors still treat their bonds as safe, there's no explicit guarantee like U.S. treasuries. Instead, markets rely on an implicit guarantee, the belief that Washington would step in, even if it's not legally required. Examples of implicit guarantees include Fannie and Freddie themselves, post-2008, CMHC or provincial farm credit agencies in Canada, and quasi-government entities in Japan or Germany. But implied protection still means higher risk premiums, and that means higher yields on mortgage bonds. Even a 10 to 15 basis point increase could raise mortgage rates for millions. Mortgage-backed securities carry a key risk: prepayment. When rates fall, homeowners refinance, and bondholders lose expected income. It's the equivalent of a call option held by the borrower. So MBS investors are short that optionality, and they hedge it by buying interest rate options, like swaptions. But those hedging tools depend on how deep the volatility market is. And a surprising player helping build that market is Taiwan's life insurers. These insurers are major buyers of Formosa bonds, long-dated US dollar bonds, often callable. By buying callable bonds, they're also exposed to prepayment-like risk, the same type of risk MBS investors are trying to hedge. So why does this matter? Because when Taiwan's insurers buy these bonds, they increase demand for callable structures. That supports more dealer issuance and structuring. It deepens the volatility market that MBS investors rely on. In other words, Taiwan and U.S. mortgage investors are linked, not because they hedge each other, but because they build the same risk ecosystem. So when Formosa demand is strong, the system works. Hedging is cheap, spreads are stable, mortgage rates stay contained. But if Taiwan's demand fades due to trade shifts, regulation, or shrinking surpluses, the volatility cushion shrinks. Here's a simple way to think about it. In the stock market, if there's heavy demand for a company's shares, bid-ask spreads tighten, and trading becomes more efficient. But if demand disappears, liquidity dries up, and trading gets expensive. It's the same with mortgage volatility. Taiwan's steady demand makes the system liquid. When that disappears, hedging costs rise, and mortgage rates follow. That cushion is now eroding. Taiwan's current account surplus was $113.83 billion in 2024, slightly down from the previous year. And here's why that surplus matters, even though insurance companies are the ones buying the bonds. Taiwan has strict controls on outbound capital. Its life insurers can only keep buying US dollar assets like Formosa bonds if the country has enough foreign exchange reserves. Those reserves come directly from the current account surplus. So when Taiwan exports more than it imports, that gives insurers room to invest abroad. But when the surplus shrinks, regulators tighten the rules, and insurers may be forced to cut back on foreign bond purchases. Fewer surpluses mean fewer Formosa bond purchases. And if Fannie and Freddie exit conservatorship at the same time, you get a spike in rate volatility risk, with no one left to absorb it cheaply. The result? Wider MBS spreads, higher mortgage rates, declining affordability, even if the Fed stops hiking. This is structural, and it's global. In April 2025, U.S. home prices fell in the 20 largest metropolitan areas for the first time in over 2 years, with a 0.12% decline from the previous month end. If spreads widen further and mortgage rates jump again, we're not just facing a slowdown. We're looking at a globally amplified housing drag, fueled by risk perception, not just policy decisions. If you found this helpful, please consider liking, commenting, and subscribing. Your support helps us keep going and keeps these stories coming your way.